Well, thank you all for joining today's webinar. As always, we've got a great webinar in store for you today, and I appreciate all of you joining us. Especially, I want to thank everyone who submitted questions. That's very helpful for me to make sure that I'm covering the issues and the items that people are concerned about and have questions on that help shape some of today's content. And of course, check out our podcast as well, because in a future episode, we will cover any of those questions that we weren't able to get to on today's webinar. Well, I always like to start off with a recap of where we've been. So let's talk about that. Let's look at the returns within the various asset classes that I commonly track. And here's where we are year to date. This is through close of business just a couple of days ago. And you can see the lines here, the various colors, those all represent different asset classes. And on the right-hand side of this graph is the return. And the leaders this year and haven't been leaders in a while. It is the international index that's represented by the EFA ETF, which stands for Europe, Asia, and Far East, and that's all developed countries. And then right below that, we have the emerging markets ETF. So those are developing countries. And they're on track for almost a 40% year, halfway through the year, just past halfway through the year, up over 19%. Next, we have the NASDAQ, which represents, typically tech stocks. There's some other stocks in there, followed by the S&P 500. Then the commodities index, so good gauge of inflation. A lot of that's represented by oil. Then we have the Dow Jones, the small cap index, and then the very bottom of the list is the real estate index that we measure. And you can see this has not been a straight line type of year. We had some volatility, picked up in February and hit a bottom here in April, and then it's been steadily climbing higher. We talked a lot about that in April's webinar, the last quarterly webinar that I hosted, what was driving the volatility and what the issues were at the time. And the headlines then were tariffs. And we'll talk a little bit about where we stand related to those tariffs and where do we see things going forward. That's always the big question is, okay, great. This is where we've been. This is a very short period of time. We're looking again just over 6 months, but this is where we've been so far in 2025. I want to take another view of this chart, and what I've done here is I wanted to point out, well, what has performed the best since this bottom here? Well, that was April 8th. That was, they were all April 8th, April 9th, kind of in that couple of day range there when most of these indices hit a low and then started climbing higher. A lot of the headlines at the time, again, were related to the tariffs, but they were related more so to the pausing of the tariffs. Okay, we're not going to start them. We're going to put them on pause and we're going to negotiate from there. And markets have reacted positively to that news initially, and then subsequent news has been fairly positive. And I'll talk through what that's been. The biggest performer since the bottom has been the NASDAQ. Now, it's up 35% since April 8th. That's the day of this chart. Now, it's not the best performer this year. It's only up 10% for the year. So think about that. So it took up the NASDAQ, mostly those tech companies. They have more exposure to shipping products from overseas here to the US to sell to US consumers. And they got hit pretty hard during that period. They have rebounded quite well, but not performed as well as the international markets, which, less exposure to the US tariffs, especially those developed and developing countries. Next best performer, emerging markets, followed by the small cap index. Then we have the international index, the Dow Jones, the real estate index, and last but not least, we have the commodities index. So we've seen quite a bounce off the lows in April. And I talked about not necessarily this happening that quickly, but I talked a lot about forward returns when we're going through a pullback. We have to think in forward returns. And as I was going through last quarter slides and prep for today's webinar, I think what I posted in our market multiple slide, which I've since updated, was over the next 12 months, based on earnings and applying a multiple to it, we could see a 29% return. And that webinar published in late April. So not quite at the bottom, but fairly close to it. You know, if you look here at this this chart here, you can see, yeah, markets had started to rebound, but they weren't near where they were, and they had still, I think, were negative for the year in some of these indices and some of these benchmarks. Well, the S&P 500 since April 8th is up 26.5%. And, you know, I'll take it. We'll just put it that way. I said 29% on the high side 12 months out. Well, we've seen a pretty significant increase, and you know, relative to that prediction that I put out there. Now let's go through the different sectors as well. You know, each sector that represents the S&P 500, there are 11 sectors. So we have the leader for the year, industrials, followed by technology, utilities. We have consumer discretionary financials. We have basic materials, real estate, you know, the consumer staples stocks. Then we have energy, and then healthcare at the bottom. So again, similar looking graph, and the combination of all of these different sectors and their weightings make up the S&P 500. Moving on to bonds, you know, commonly called fixed income. I have different bond yields represented on here. So we've got the 10-year yield. So that's when you loan your money to the government for 10 years. What is the rate of interest that you receive? And this purple squiggly line represents each day the closing yield for that day. So that's what you would have received for the forward the next 10 years had you invested in 10-year government bonds at the time. And they've moved a little bit. You can kind of see a range here. As high as 4.8% at the beginning of the year, as low as, call it 4% on the 10-year just after April, and now we're sitting at 4.39. Point to point, yields haven't moved a whole lot on the 10-year, but the 5-year and the 2-year have come down. Something to take note of. Maybe that's an indication that investors are expecting yields to come down, or there's more money flowing into bonds, because bond yields are a function of supply and demand. So the Federal Reserve, you know, there's been some chatter recently about the chairman of the Federal Reserve, Jerome Powell. He may resign. It sounds like the current administration, President Trump, is not too pleased with Mr. Powell and would prefer for him to resign. Now, I think Trump is the one who nominated him to begin with, and I think Powell's done a decent job, and he's concerned about inflation. So he's talked a lot about inflation and making sure inflation is under control, because he doesn't want to have what we went through during 2020, where interest rates, you know, specifically the Federal Reserve raised interest rates, and then investors followed suit and yields rose in 2022. And that can hurt especially long-term bond investors. The longer that you have your money invested in these instruments, the more volatility you'll experience when interest rates fluctuate. So if you buy a 2-year government treasury, well, you're going to get your money back in 2 years. So there's less exposure to current interest rates. So if interest rates come down, you reinvest at a lower rate. However, when interest rates come down, your bond values go up because you own those bonds at a higher yield, and investors are willing to pay more for that from you if you were to sell them. And it works the opposite direction too. When yields go up, your existing bonds are worth less. Again, 2-year government treasuries, government bonds, you don't have to worry about that as much because your bond's going to mature in a couple of years and you're going to have your money back to reinvest at that higher yield. When you go out 10 years, 20 years, there's even 30-year government bonds. The longer you go out, the longer you have to hold it to get your money back. You get your principal back, assuming the U.S. Government doesn't default, which they never have, despite what the rating agencies want you to believe with their credit ratings and changing them for the United States. The United States has never not paid an interest payment, so I don't think there's as much risk there. Maybe sometimes as indicated by the rating agencies, but again, bonds react to all of that, and investors react to all of that, and can create some short-term noise when those things happen. Here's some more bond yields, and you'll see some interesting things here. And this has been this way for the last several years when interest rates rose. So in the middle, you can see a red line and a blue line, and they're fairly straight. And more specifically, that red line, that's pretty straight, and it's up. That symbol is SHV, which represents the short-term Treasury ETF, and that's going to follow interest rates that are very short-term. Those represent a basket of actually what they call are bills. They mature in less than 1 year. And I would say that's going to closely mimic money market funds. Now, there's some differences there because money market funds historically have been at $1 a share, and then you earn your interest and doesn't really move. We've had some very rare circumstances with COVID and 2008, 2009, where a couple of money market funds there's not very many that did fluctuate a little bit around that dollar mark, but for the most part, they stayed $1 because they mature so quickly. You've got a bunch of things in there that mature in 90 days and they reinvest 90 days, every 90 days. And they're going to represent kind of what really short-term interest rates are. Well, SHV is up 4.5% for the year. You start doing the math there, you might think, well, that's on track to be almost double digits by the end of the year. Well, interest rates aren't that high. How is it doing that? Well, it's because short-term rates are coming down. I showed you on that previous slide, the 2-year Treasury has come down some. So those existing bonds have gone up in value. The more volatile lines, like the orange and the light blue, well, those represent longer-term bonds. The orange are 20-year plus government treasuries. So you buy that, you hold it for 20 years, you receive your principal back, and then whatever interest rate you used or received when you purchased that bond originally. So when interest rates fluctuate, they have 20 years or more of coupon payments, of interest payments to you that need to be discounted at whatever that rate is. So when interest rates go up, they're worth a lot less. When interest rates go down, they're worth a lot more. Unless you sell them, it doesn't really matter what they're worth, but you could sell them at a gain or a loss in between there. And there's definitely investors who play that game knowing that, hey, I'm not planning to hold this. I just think interest rates are going to come down and I want to own a long-term bond and potentially buy it at the peak here and then sell it when it comes down. or vice versa. This would be the opposite. This would be the performance. So you know, this would be interest rates coming down, interest rates going up, and the performance of that. So this TLT has, you know, has historically been volatile. This isn't anything new. It just represents the impact, and you can visually, I think, see it a little bit better, because some years there isn't a bunch of movement and it's fairly stable, but most years there's especially since 2020, you know, since COVID, we've seen some more movement in the fixed income markets or in the bond markets, because interest rates have been fluctuating, especially during 2022. You know, these long-term bonds took a significant hit. So for all of our clients that are on today's webinar, you know, our strategy when it comes to bonds, you know, I talked a lot about last time diversified portfolios, and really focused a lot on diversification among the different stocks and the different asset classes. So you don't always receive whatever is displayed on the financial news related to the Dow or the S&P, because we own more than that. We don't just have everything that's in the S&P. We own international stocks, not as much as most do, but we own some. We own some small cap stocks, some mid cap stocks, stocks that are considered value stocks. You know, they're more established companies that are typically paying dividend payments. Then you have growth stocks that are historically younger companies that are reinvesting everything back in the business, looking to grow the business, grow market share. That's kind of the difference there. And there's large value, mid value, small value. There's value in every different market capitalization or different size of company, and there's growth in all of those as well. And bonds are the same way. You want to be diversified in the bonds. However, we have a significant overweight to short-term bonds, and that's for a couple of reasons. One, when you're taking distributions out of your portfolio, we want to have a stable investment for the times when the market's down, because we know it's going to be down. We don't know exactly when it's going to happen. No one has a crystal ball. You know, I like to discuss that during these webinars, kind of our opinion and where we see things going, but I can't say for certain when the peak is and when the bottom is, and hey, we're going to sell everything at the high and we're going to buy it all back at the low. As much as I wish I could, that's not possible. And anyone who's telling you that they can do that, I would say you should be buying a lottery ticket if you believe them when they say that, because they probably wouldn't be talking to too many people, because their performance would be so good they wouldn't have to tell anyone. They could just manage their own money because they'd have so much of it if they were able to do that. But we own short-term bonds, and this is a great chart this year, because the red line is going to have a lot of where our retired clients, where the distributions are coming from. They're going to have a lot of exposure to that. Not all of it, but a lot of it. And we're going to have some in what we call intermediate term bonds that mature less than 5 years, maybe 7 years max. And then very, very little in this long-term bond bucket, because it's very volatile. Now, if we wanted to make a trade or an investment in long-term bonds because we felt that interest rates were high and it was important to capture that high interest rate, but also because we thought interest rates might come down and we would get a capital gain, or we would make a positive return in the short run, well, that would be more of a trade than it would be a strategy around withdrawals and distributions. So yeah, just different ways to think about bonds, and I hope that clarifies some things, because we definitely get questions on bonds and how they work from time to time, because not everyone's familiar with the fact that they do fluctuate like they do. Now let's talk about the economy. Love talking about the economy. I've got my leading indicators that I always monitor and update for us every quarter. And the reason I talk about the economy is because, well, the stock market and the economy, yes, they're not tied one-to-one. There's no direct, hey, when this happens in the economy, this is what's going to happen in the stock market. But when you look at it as a whole, and you can see, okay, well, what are the different trends and what direction is the data going, that might give us an indication of where we think stock prices might be going in the future. And, you know, a big portion of the stock market, well, it's some of it's driven by emotion on the short run, but long term, it's driven by earnings. Well, earnings are a function of revenue, and companies earn revenue when they sell products and services. Well, who do they sell those to? Well, typically they sell them to individuals. That's the most common way, but there's also businesses that sell to other businesses who then sell to the consumer. So the consumer is at the heart of so much of the economic cycle and the future direction of the stock market. So when consumers, when people have jobs, they have money to spend. When there's less jobs available or people getting laid off, there's less money being spent, which means less revenue for these businesses, which means less earnings. So I talk a lot about the jobs market and the health of the consumer, which we'll go into that a little bit more today. Well, here's a graph of just total payrolls. So it's everyone receiving a paycheck here in the United States. This this graph goes back to just prior to the summer of 2019, June, July of 2019, all the way through the most recent data point here, which was just early in July. We'll get another update. This comes out monthly, so every month there's a new data point, and this chart updates. These are all from the St. Louis Federal Reserve, and our longtime webinar viewers will probably remember me talk about this. There is a plethora of data on that website. It's actually linked here at the bottom, fred.stlouisfed.org. And if you go there, you can access more data than you probably care to know, but it is, I believe, very interesting, and I review that on a pretty regular basis because what I want to know about the trends. What direction? It's not each individual data point makes up the trend, but each individual data point isn't necessarily the end all be all. Like, well, this month it did this. Wow. Okay. Well, it's like, well, is that a blip? Is that expected? Is the trend now changing? Are we entering a peak in the economic cycle and potentially moving into a contraction? That's really what I want to know. Or are we still in the expansion phase? Well, just by the shape of this graph, you might think, well, maybe we are at a peak, but we don't know what this graph's going to continue to look like in the future, and it may just continue on that same trend line higher. I mean, the data is pointing to that, at least in the short term, and we'll have periods where it does peak and it goes down. This graph here also has these shaded bars, and all of the St. Louis Federal Reserve graphs have the same concept with them, with whatever the data is on either left or right, the data points, and then you've got time at the bottom, and then any gray shaded bar represents a recession. Well, this is COVID. Very short recession, lasted just a few months, and the people who determine we're in a recession, they say, hey, when it started and when it ended, but they don't tell you the exact month it started when it starts. They wait a few months, and it's because they have to see, well, we need more data. We can't just say, well, March of 2020, recession started because it's March and COVID hit and we know recession started. No, they didn't actually announce it till a few months later. And then this gray bar lasted for a long time until they came out and said it ended a few months in 2020. And then they go back and they update the chart to actually show the real data. So again, things to be aware of when you do look at data. Doesn't always paint the picture as if you were in real time, because in real time it actually looked a lot different than this. Well, pre-COVID at the peak, 152.5 million people in the workforce. We are now almost at 160 million people on payrolls here in the United States, and that trend continues to tick higher. Not nearly as robust as we saw coming out of the contraction, and that's common. You're going to see a significant more increase in payrolls, and then as the economy starts to mature, less and less increase in payrolls, but we're still seeing 100, 200,000 in positive job growth every single month. And we haven't had a down month in job growth and in payroll numbers since COVID in 2020. Now here is a graph of job openings. So these are employers that they're being surveyed, and then they take the data and they extrapolate it to come up with an estimate, but that's how they've done it ever since they created it. So the data at least gives us something to compare to historically. And you see the peak here pre-COVID, yeah, job openings were, call it 7.5 million. We are sitting very close to that, 7.7 million. We had a little spike here, and some of this is just kind of summertime increases, for those that are in the Midwest. There's jobs that high schoolers take that maybe don't take them, or college students take that maybe don't take them during the school year, but then fill them in the summertime. Or if there's businesses that have very seasonal businesses, so they do more hiring in the summertime, less hiring in the fall and winter. And you can see job openings kind of spike if you look historically in those seasonal periods. Now they try to adjust it for seasonal trends so that doesn't just create some noise in there. But I think, this is an indication that there's still demand for workers. Not as much as there was in 2022. There is a significant demand for workers, over 12 million job openings. And the reason I go back far on this is because I want you to see historically how that compares. Pre-2008, before the Great Recession of 2008, 2009, pre-COVID, and here's where we're at today. There's the COVID recession, a couple months compared to the much longer and deeper recession of 2008, 2009. And then we had the recession after the dot-com bubble burst in late 2000 into 2000 and end of 2001 at the beginning. So job openings, employers still need workers. Very, very, healthy sign that companies are hiring. They're still hiring, and they can't fill every single opening as much as they want, and how much. It's all a lot of factors go into that. How much they pay, where they're located, what's the access to the workforce, things like that. Now this is a graph of long-term unemployment. So those are people who file for unemployment claims, and then they continue filing for unemployment claims for longer than just the initial kind of month or two. They're considered long-term unemployed. And this helps us identify, well, if we see a trend higher in this graph, then we'll start to think, well, okay, wait a minute, there's a lot more people that are looking for work, because that's part of the definition of being considered unemployed, is you have to be looking for work. So this doesn't count retired folks or folks that just dropped out of the workforce. You might have someone who recently had a baby, and one of the spouses was in the workforce and now they're not anymore, and they're not actively looking. They wouldn't be filing for unemployment typically if you resigned. But if someone filed for unemployment, they're actively looking for work. They want to be in the workforce, is how they define this. You see the big spike there post-COVID, then the decline showing all the hires that got picked up, and then we've been fairly steady. It's been trending slightly higher over the last couple of years. You kind of look at that graph, you might notice it's just ever so slightly trending higher, but it's not much higher than where it was pre-COVID. You see 1.8 million. That was pretty low at the time, and we're still fairly low. It's kind of like when you talk about mortgage rates, and they're 6.5% nowadays, and everyone's, wow, they're really high relative to 2020. Because in 2020 and 2021, when COVID hit and interest rates went down significantly, mortgage rates went down significantly, and you could get a 30-year mortgage. I've heard of some people as low as 2.75% on a 30-year mortgage. Well, that doesn't exist today. Doesn't mean it won't come back in the future, but it may not. Interest rates were zero for the better part of 7 years, kind of post the great financial crisis, started to creep back up ever so slightly post that, and then we had COVID hit, and interest rates came down again. Now they're back up, and people don't like paying 6%, but we have a lot of clients that were buying homes in the early 80s, and they all say 6%, that's still pretty low, because back in the 80s it was double digits, 10%, 12%, 13% for a mortgage. So it's all relative to what has been most recent. That's always interesting when people have different perspectives based on one, how old they are, and two, what they've been living through. Retail sales. So this shows just a gross sales figure, if that's trending higher or lower, and retail sales is continuing to trend higher. That looks good. We have new home permits. So this is new housing being authorized to be built. So this doesn't show anything about existing housing or homes for sale. This just shows new housing, which is a leading indicator, gives us a sense of, okay, who's willing to begin building a home, whether it's the purchaser of the home is contracting with the builder and they're getting that all done and issued that permit, or are the builders potentially just putting out some spec homes. Haven't seen much of that kind of post 2008, 2009. A lot of builders really struggled during that period, and it was because people weren't moving, they weren't buying homes, jobs were being lost, and usually you're not in a spot at that time if you've lost your job where you're looking to build a new home. So that's kind of a sign to see, and we've seen it stagnate. Now, it hasn't dropped off a cliff. It hasn't. You look here, kind of pre 08, 09, new home permits. I mean, they just dropped like a rock. And then we had the 08, 09 recession, and I mean, it was a while. It doesn't look like much, but those several years where hardly any builders were doing much, and then it slowly crept back up. We had COVID hit, and then interest rates spiked in 2022, and that did slow things down, but it didn't just drop it off a cliff like it did pre 2008, 2009. We saw something similar in the early 70s, late 70s. Not as much of a cliff drop off, but definitely a downtrend in mid to late 80s, followed by the housing boom, and then now back kind of more on that sideways trend. Again, I continue to monitor this. We kind of see, and that's one thing that's showing definitely some signs of weakness. It's not, again, not a warning, hey, we're on the cusp of a recession. I mean, if you talk to realtors and real estate agents, they may think we're in a recession if they're not very busy, but you got to look at the economy as a whole. This is business spending. So are businesses buying inventory? Are they investing in what we call capital goods or capital expenditures? So those are typically big expenses. This excludes aircraft because that would skew the numbers because they're very expensive. But you can see businesses they're trending sideways, but they're still spending money, and it's nearly at the peak, but it's definitely higher than it's been historically. And you start to see these downturns generally around recessions. Businesses stop spending, they start laying off people because they feel like, well, we need to start preserving capital to maintain our earnings so our stock prices don't get hit. But also, we don't want to be overstaffed if we think there's going to be a slowdown in the economy and have people that we don't need. So they're going to start laying people off when they're definitely not spending. And then this last graph here, this is the yield curve. I've talked about this from time to time. It gets more media attention, especially when it first inverts. So this is the 10-year government treasury minus the 3-month government treasury. So What this indicates is that when the blue line dips below the solid black line, which is, it represents 0, the 3-year treasury, or excuse me, the 3-month treasury is paying more interest than the 10-year treasury. So you're incented to keep your money in short-term instruments because you earn a higher rate of interest than if you were to go buy 10-year bonds. And that inversion has a pretty good track record of predicting the next recession. Let's go back here to 1990, yield curve inverted, recession. 2001, 2002, yield curve inversion, recession. 2007, 2008, yield curve inverted, recession. We had end of 2019, early 2020, recession. Now, a little caveat to that, I wouldn't say the yield curve predicted COVID, but what it is a sign of is that capital or money is tight. It's harder to get loans when yield curves invert. It's cost businesses more, and that's why it would predict a recession. It's like, well, that's a sign that, well, the Federal Reserve is raising short-term rates, and these 3-month treasuries are following suit. Investors are bidding those higher, the yields higher. But then you also have capital flowing into the 10-year treasury, and it's bringing rates down. So more money is kind of being deposited in those long-term bonds. So investors are maybe shifting their portfolios, or speculators are in there too. But we also have the Federal Reserve in there. They have their federal open market committee, and they go out and they do quantitative easing and quantitative tightening. That's been something that was a term used very much so post 2008, 2009, and that was the way the Federal Reserve was, manipulating, really is the way to, I think, the way to think about it, the yield curve. They were out there buying and selling bonds to keep interest rates in a range where they want. Even though they control interest rates, they control the short-term rate. They don't control all these other ones. That's supply and demand. Well, they were out there kind of artificially increasing supply, increasing demand, just to keep rates where they wanted. So these couple of yield curve inversions, those have been manipulated by the Federal Reserve. So I think there's little less weight carried with those inversions. And that's part of the reason why I think you're not hearing about them nearly as much as you used to. Now let's talk about earnings. This is what stock prices, ultimately they're a function of earnings. So you can go back, this is going back to the entire year, 2015, 2016, 2017. And what this does, this company is FactSet, and they take all of the individual components of the S&P 500 and they figure out their earnings. So they weight those earnings based on the percentage of the S&P 500 they make up. So just, this is a made up example, but let's say the largest company in the world, gosh, it seems to be, kind of changing from time to time, but let's just say it's Apple, and Apple earns $1 a share, and Apple represents 10% of the S&P 500. That's not what it does. That's not, these aren't accurate numbers. This is just for ease of the example. But if they're 10% of the S&P 500, they make $1 a share, well then 10% of that $1, or 10 cents, would be added to the aggregate earnings. And so they do that for all of the companies in the S&P 500 to get this total. Well, in 2023, excuse me, that number was $220. 2024, that's been finalized, $243. 2025, what we're in, so we don't have all the data yet. We have Q1, that was released in April. And now we're starting to get numbers for Q2, and we'll get Q3 in October, November, and then we'll get Q4 in January, February, and then we can close out what the numbers actually were when they're released, because they're released after the fact. but this includes analyst estimates for the year. And if you watch some of my previous webinars, you'll see how these numbers change. They're not the same every single time I talk about it because it reflects current estimates. But this is important because, again, stock prices are a function of earnings, but the market also discounts current stock prices based on future earnings expectations. So the market is looking at the next 12 months and potentially longer, but call it the next 12 months. Well, over the next 12 months, it's a combination of what's remaining in 2025 plus the first half of 2026. But by year end 2025, the market's 2025 is over. The market's looking at now 2026 earnings. So as we get closer and closer to 2026, the more important 2026 earnings are. So that's why this is important to look at future earnings estimates to get an idea of, well, what do analysts think? You know, again, they can't predict the future, but this is an aggregate of a lot of analysts, not just one person, coming up with these estimates. And that's what FactSet, which is who provides this data, is displaying here. The next piece to this is how I come up with my market multiples. Then we apply a multiple to those earnings. So we take that $301 and we say, okay, well, by year end 2025, the market should be trading based on a function of 2026 earnings estimates. Well, they're currently at $301, so that's the number we're going to use. And if we say, okay, we've got current as of the end of business on 7/21, S&P 500, 6,305. That's where it was. We have future earnings estimates at $301. And we say, okay, well, let's multiply this by a multiple. People are willing to pay up for these earnings. They're not just paying 1 time, they're paying 18 times or 20 times or 22 times. And actually currently the market's trading at, so if you just take current earnings and you multiply them by, or excuse me, you divide the current S&P 500 value divided by the current earnings, 264, you get a almost 24 times multiple. Well, that's why I included that on this one. I wanted to show you, well, this is where the market's trading at. But let's say multiples came down. Investors aren't willing to pay as much as they are currently for future earnings. What would impact that? Well, outlook maybe is a little less clear. You know, it's never perfectly clear, but maybe a little less clear. Interest rates are an unknown. Interest rates, higher interest rates, typically that means lower market multiples. Not always. 2022, the multiples didn't necessarily come down. I mean, prices went down temporarily, but they came back, even though interest rates still haven't gone down much since then. A little bit. Federal Reserve has lowered them, but the 10 years at nearly 4.5, and you know, it was maybe higher than that a little bit, but it wasn't like it was double 10% or anything in 2022. So higher interest rates, people start to weigh, well, do I want to own stocks? Do I want to own bonds? Are bonds more attractive at higher interest rates? Potentially, but again, you got to have an outlook on inflation. You know, 2022 inflation was much higher. So you still were going backwards. If you actually look at what the inflation data was in 2022, and you look at the interest rates and you're like, well, I'm not keeping up with inflation. If inflation's 9%, which it was for you know, annualized during certain months, it wasn't, you know, for the year, but it was a lot higher. For those that are on Social Security, you remember, well, you got what, 5.8% one year on your Social Security cost of living adjustment. That was pretty high. It hadn't been, you know, very high for a long time because, you know, according to the government, inflation was low. Now we all know, well, yeah, certain things cost more and the government weights different things differently based on what they think a consumer would purchase. So it's not always going to mirror your habits, but it's a general consensus of what inflation is across the country, across different workers and retirees and young folks as well. Well, these are stock, this is of the value of the S&P 500 at year end 2025, assuming markets earn, or this is still the estimate at the time. And again, I update this every quarter based on what current estimates are, times 18, that gives us this number, times 20, that gives us this number, 22, so on and so forth. Well, that gives us a range. And that's what I like to talk about, ranges a lot, because I can't say for certain where it's going to be, but if things go well and continue to go well, yeah, we're probably closer to 22 or 24. If things really start to turn and we do start to see job layoffs and other things, yeah, we're probably going to be closer to that 18, because now the economy could be peaking and it could be entering a contraction phase, and earnings and people's outlook for the futures generally get worse when the economy is not performing well. So that gives us a range of minus 14% to positive 14% over the next 12 months from the value of the S&P as of June 2021. Now, I think we're going to still be closer to that high end, and I'm going to show you why after I go through interest rates and inflation here. So interest rates currently in this range, 4.25 to 4.5. It's a floating range, but that's pretty close to where the Fed has them on any given day. But this is actual interest rate future. So this is where investors place an investment and say where they think interest rates are going to be in the future. And again, this does change based on really headlines. It can change significantly based on headlines, but currently we're looking at as low as 3.5%. If you look at the big three bars here, that's going to be the majority of where the investors have their money placed, all the way up to the high end of 4.25. So what that would indicate is, okay, maybe on the high end, we don't see much lower interest rates, but more likely to see lower interest rates. At least that's what the market is anticipating. When you go back to 2022, this was the big surprise in 2022. The beginning of 2022, there wasn't, interest rates were low, and the futures market really wasn't expecting much higher interest rates, maybe a little bit, but not 4% by the end of the year, which is where pretty much ended up being by the end of the 2022, because the inflation data just kept coming out worse and worse and worse, and the Federal Reserve kept raising short-term rates to try and be ahead of that. And that was a big surprise, because again, you can look at the data, go back to my webinar in Q1 of 2020, and you can see what I said about interest rates then. I didn't predict that they would be higher. It's just more so a snapshot of what the investors at the time were anticipating. Well, they got a surprise. And again, when these surprises kind of pop up, that can create some turmoil or some volatility in the markets. Here's the inflation data. I said as high as 9%. That was June of 2022. So if you were buying 10-year government treasuries at the time, let's say you could get 4 or 5%, you thought, well, that's better than than what I had been getting, because prior to this, interest rates weren't much higher. You still, though, weren't keeping up with inflation. Now, depending on how far you purchased those, let's say you bought 10 years, a 10-year government bond at 5%. Well, now inflation's come down. You're kind of ahead slightly based on current rates. And this is what they do is they sum up all the data and then they annualize it. So when June 2025 says 2.7%, well, that's what it is, annualized. Same here with this 50-year average. I mean, I think this is important to look at. Look at the 50-year average. Core CPI, headline CPI. So core excludes food and energy, headline includes food and energy. Those are the two differences between those two. 50-year average, they're very close, but on the short term, food and energy can fluctuate a little bit more, and that's why they exclude it on core, just to show you the difference between those figures. And May, June, we're lower than the long-term average currently. All right. Well, where are we going? Are we headed into the next recession? Well, let's talk about that. Well, the big headlines, tariffs, and I showed this graph in April, added a little bit more color to that graph. This was shared by JP Morgan, and they did a lot of research on this. So the year-to-date tariff for 2025 effectively is coming in at about 4.7%. You can see the tariff rates going all the way back to the year 2000. They were high in 2000, came down, spiked back. Excuse me, this is going back to 1900. And then as the world and the economy became more globalized, tariffs started to trend lower post Great Depression and got to where they were in in the, call it 2010 area, where they pretty much as low as they'd ever been, started to creep back up, and then we've seen our spike here on the effective rate currently. Now, if there's no change in imports, this is what would happen. Now, recent headlines are still indicating some pauses there. And then if we were to go back to what they were being discussed at the peak, which coincides with the market low, was nearly 30%. So that's why it was such a big reaction by the markets, because that is a significant increase in costs, whether the company eats it or they pass it on to the consumer. I mean, most likely companies are going to pass it on to the end, the end buyer. They're going to say, well, it cost us this much more to import the good. We have to raise prices by either that amount or, maybe some large portion of it to at least maintain some level of profitability. Let's talk more too about the jobs market. I shared the total payrolls, slightly increasing over the last several years. The job openings. Well, here's another chart. These are layoffs. Most recent data point is May of 2025. You can see it's indicated here by that blue dot. And this goes back to the year 2000. You can see, well, layoffs are still historically fairly low. You look back at these periods over the last 25 years, and you can see they generally have been higher, and for years at a time, even maybe a decade, where they've kind of been in a range until we have a recession and then layoffs start to peak. Now, that's more of a lagging indicator, so that's not why it's part of my leading indicators. Layoffs are something that companies do after the fact. I mean, some try to get ahead of it, but most of them are reacting to the economic data, not necessarily getting ahead of it. We also have payroll gains. So this is net of any layoffs too. So 147,000 added to the payroll in June, which was just released first part of July. We're going to get July's here in the first part of August, and again, they revise the data. They come out and they say, here's our indication as more data comes in, and it changes what it was over the last few months. Well, then they revise it, they correct it. So these charts can change from time to time on a historical basis, because they do update it based on what they have, but it's not generally big significant changes. Sometimes there are, and we talk about that when they do happen. And then we have the gray, the 3-month trend. You can see post-COVID, you have a lot of jobs being added, and that slowly slowed down, but it's still positive. That's the key. It's still positive. Now we have the unemployment rate, 50-year average, 6.1%. Currently for June, 4.1%. It's been slowly increasing. And people might think, well, wait a minute, we're not losing net jobs. I mean, we have net job gains because it's net of layoffs. It's always, well, how many layoffs we had, how many jobs did we have, what's the net amount? Well, when more people enter the workforce, then we have a larger workforce, and percentage-wise, maybe less job gains relative to the total amount of the workforce. So that can increase the unemployment rate, even though we have positive job gains. It's usually not going to be a significant increase, but that's been part of what's been happening is more people are coming into the workforce, and they aren't just getting jobs right away. Then we also have in the blue wage growth, and when you do see lower rates of unemployment, you generally see higher increases in wages. And the reason that's important because that can lead to higher inflation, especially when people are making more money. They're going to spend more money, more dollars chasing less goods typically leads to higher prices. Their balance sheets too. Consumers are still in very good shape. I mean, all of the assets for all of the consumers total $190 trillion, and debts total $20.8 trillion. And the debt service ratio, so that's the interest payment, excuse me, I mean, it's the total payment, not just the interest. So it's, principal and interest on a mortgage. I mean, it's the total payment relative to a percent of their disposable income. So that's income after taxes. Still low. I mean, it peaked at 15.8. We're at 11.3. Yes, it's gone up as interest rates have gone up, but it's still not where it was pre-COVID. So historically, that's a low figure. Real GDP, so this is the gross domestic product. This is the sum of all goods and services that are produced here and sold here in the United States. We're right on trend line. Yeah, there was a slight quarter-over-quarter decrease in Q1. We're going to get Q2 here soon, but year-over-year, positive 2%, and that's after inflation. So you would add the inflation figure to this to actually get the gross number. This is net of inflation. They strip that out because they want to make just historical comparisons, because they know when inflation's higher, well, generally growth is going to be higher because prices are all higher, values are higher. They want to strip the impact of that out and just look at just growth by itself, not growth because of inflation or deflation if we were experiencing that. This is what makes up GDP. 68% of its consumption, which means that's 68% of the growth here in the United States is related to consumers buying goods and services. So that's me and you buying products, buying services. That's the largest portion of GDP, followed by businesses, what they're spending. This is X housing, this 14.6, housing's 4%. State and local governments spend 10.8% government spending. So, you can see is one of the things from an economic standpoint you look at, well, is government crowding out? Are they spending more and more? Are they becoming a bigger percentage of GDP? Meaning, well, now it's less dependent upon consumers if that's happening, and more dependent upon the government spending money if that continues to increase. Now, we've had this 68%, 69%, 70%. We've been in this range for quite some time, so it hasn't been happening, but something that we pay close attention to. And then we look at the impact that imports and exports have on this, and we currently import more than we export, which is a negative on GDP. Investor sentiment too. Well, how are people feeling about the market? So we talked about jobs. Jobs still, there exists. There's more being added. Unemployment rate is low, lower than the 50-year average. Wages are, still growing, 3.9% over the last 12 months. And inflation, the data there said 2.7%. So wages are growing faster than inflation, which is typically a good sign. So people are keeping up with inflation, at least on the current metrics. People should be feeling good. Well, the chart on the right here is consumer sentiment, and this is measured by a survey. University of Michigan publishes this, and it's quoted, very frequently when it is released. But consumer sentiment is a contrarian indicator, meaning when consumers are the most negative about the outlook over the next 12 months. That's kind of what they look at. The next 12 months, what's your outlook? Are you optimistic? Are you pessimistic? Where do you lie? And they do enough survey for it to be statistically significant, and they plot it on this graph. Well, whenever it's hit a peak and starts to rise, or excuse me, hits a trough or hits a bottom and starts to rise again, that's always great for forward returns. So when we see these low consumer sentiment figures where people are like, man, I just don't feel good about what's going on, that's a great time to be buying or rebalancing the portfolio. And here's where we are currently. We're still very low. Now, we've bounced since April. Markets went up. People are starting to feel better, but we're not near the average going back to 70 at all. And when everyone's feeling great, that typically indicates maybe we're at a peak. And we haven't had a peak here in a while. The most recent one was March of 2024. It still didn't hit the long-term average, but it peaked and went down again. And then on the left-hand side of this slide here, you've got investor kind of sentiment, I guess, and how they're positioning themselves. And we have on the very left of the dial extreme fear all the way to extreme greed, and definitely on the greedier side, which is to be expected when you see, I just, when I showed you the data from April 8th, NASDAQ's up 35%. Yeah, people are feeling pretty greedy, thinking, well, that's great, and they're positioning themselves in a more aggressive posture is what this is measuring. And this could be, again, a contrarian sign. Isn't always. It's more so looking at when things are, when people are pessimistic, less so on the optimistic side, because the optimism can last. It doesn't mean things are just going to go negative just because people, they're optimistic, it's time to sell everything. No, we've seen where greed and extreme greed, and we've seen this optimism on this graph where markets didn't just go down just because it hit it. You definitely see more so, hey, troughs and bottoms can lead to significant bounces in the short term. Businesses, they're spending money. I talked about that. And AI is a huge talking point in business, and lots of discussion in conference calls for those that are still in the workforce. I'm sure you're hearing about it nonstop. You're hearing probably a lot about it just in your social interactions and just on the regular media, because it has really shown up in the last couple of years and taken hold too, in terms of businesses willing to and wanting to spend more money on AI. And that's what the graph here in the middle is looking at, is how much capital in terms of billions of dollars, that's what the number at the top of the chart is being spent on AI and implementing AI. And then you've got the different sectors, information technology. Okay, what was it, the spending as a, how many firms were adopting it? Now let's look at June of 25, how many firms were adopting it, and then what's the projection next 6 months? You start adding that all up, it's like, wow, it's really being adopted, and a lot of money is being spent on AI, which also means for those that are in the data center world and the construction of data centers and the operation of data centers, there's a lot of computing power and energy that is needed to process all of the data and everything that goes along with it. And there's been a big boom in that area of of the construction world, of the engineering, architecture world related to those projects. Now, I always like to talk about this from time to time. I don't talk about it every single quarter, but this is a graph of volatility. So what it shows us is kind of two things. The red number at the bottom is how much the market dropped from a peak during the calendar year that it represents. So in 1980, this is the very first bar, the market dropped 17% from the peak to a bottom at some point during the year. It doesn't necessarily mean it was down 17% for the year, it just means at some point it went down 17%. And then the gray line at the top and the number at the top of the gray bar represents the end of year return. So Had you just done nothing, you would have made 26% for the year. However, it did drop 17% at one point during the year. Well, if you look at most of the gray bars, almost every single one of them has a negative number associated with it. I see 1 0. There's a couple positive ones over here, a couple positive ones over here, where markets didn't really decline. They just climbed higher. Those are the rare ones where the markets just climb higher every single month, every single week, every single day. I mean, they don't go up every single day, but over short periods of time, they just kept creeping higher. Most years, you're going to have a drop. And on average, it's 14%. So far this year, S&P 500, I have it as of July 21, up close to 10%. As of the 18th, it was 7% according to JP Morgan. Well, it was down 19% from the peak at one point on the S&P 500. And now it's positive. And it's on track to have double-digit returns for the year. And how long do these recessions last, too? I mean, this speaks to so much time and energy is being discussed around predicting the next recession. There's a recession, there's a recession, there's a recession. It's coming, it's coming, it's coming. And hardly anyone ever gets it right because they don't know. Again, we have the data to help us identify, okay, are there turning points? Still, we don't know how deep the recessions are going to be. Some are mild, some are deep. Well, here, the blue lines represent how long the recessions last. The gray lines represent how long the expansions last. Well, you can see the expansions significantly outweigh the recessions, but on average, recessions last 14 months. This is a drop in real GDP during those recessions. Great Depression, the big one. You see the global financial crisis, but COVID was a very big one. Now that was government kind of induced because they told everyone to quit working and stay home. And it was very short-lived. During 2020, markets went down nearly 40% from a peak down to the trough, and at the end of the year, they were positive. I think it's good to have that perspective. So just a reminder, over the next 12 months, based on current earnings estimates and my market multiple calculations here, we've got a range of minus 14% to positive 14.5%. And we're supported by some data with that. And that's why I say I think on closer to that 14.5%, that's where I say the odds lie. And we've got momentum on our side. That's what this graph is indicating. So what it says is S&P 500 performance after a negative Q1 and then a positive 10% in Q2. So performance was negative in January through March, but then from April through the end of June, S&P 500 was up 10%. Doesn't mean it was positive for the year, but just that momentum shift. Here's average and median returns for the times that that's happened. It hasn't happened very often, but for the times that it's happened, what's the Q3 return? What's the Q4 return? And then what's the final 6 months, the cumulative return after we've had that happen? All three of them positive 100% of the time. Median returns 8.5, 8.2, 18.8% for the second half of the year, compared to just all years. So this is just showing, well, what does the market just do on average? So let's, we're going to pull these out because they meet this criteria, but then we're going to look at all years since 1950. Markets are higher. Q1, you can see, Q3, Q4 is typically pretty good. 80% of the time it's higher with a median return of 5.3%. And then any given year, or at least the last 6 months of the year, you can see 72% of the time it's higher, 6.2% median return. That's all year since 1950. I mean, just even looking at that one, you'd say, gosh, the odds are in our favor just by owning stocks and not paying attention to any of the stuff I'm talking about, not paying attention to the media, just owning stocks and understand, hey, it goes up and down, but over long periods of time, it trends higher. Here's another piece of analysis where we've got the S&P 500 after 3-month gains of 25% or more. Again, it's only happened a few times relative to all years since 1950, but we've had 3-month returns over 25%. So we pulled those out. What was it? 4 weeks in the future, 12 weeks in the future, 6 months in the future, then 12 months in the future again. Besides the 1 month, the very short term, 3, 6, and 12 months after that's happened, 100% of the time positive in these previous instances when it's happened, with 12-month forward returns median 18.5%. And this is all years, just looking at forward returns, nearly 74% median return 10.4. That's why we say, well, 2/3 of the time or 3/4 of the time the market's higher. That's what this is showing here on this one. Yeah, average median 10%. Yeah, it doesn't go in a straight line, but when we have a down period and then a big spike up, we have momentum. That's what my point with this is, momentum, and that's why I feel we've got that on our side going into the later half of this year and into the first half of 2026. Well, I went a little long, so hopefully everyone is okay. If you had to leave early, just know, I guess you're not listening to this right now, but we will send out the replay to everyone that joined us. You can check out previous webinars. I know I've referenced those a lot. KeenWealthAdvisors.com. Go to the retirement resources page where you'll see blog, podcasts, and again, those webinar replays there. Also, Bill Keen's best-selling book, Keen on Retirement, Engineering the Second Half of Your Life. If you'd like a copy of it, if you don't have one, misplaced it, gave it away, would like another one, just send me an email, mwilson@keenwealthadvisors.com. Happy to send you one. Happy to send it to anyone that you think would get value out of it. Just send me an email. We'll do that at our expense. And, one of the last things, hey, I just, I think it's, we were really, excited to get this. It was a surprise. We received from USA Today a recognition of one of the best financial advisory firms in the United States for 2025. Want to mention that. And then lastly, our YouTube channel, you'll find some videos, some content that we don't publish anywhere else. youtube.com/@KeenWealthAdvisors. Again, thank you all for joining us. Look forward to seeing you all at our next webinar next month, and then our next quarterly update that I will post in October. Thank you.